Hello everybody, and in true South African flair, how's it? And thank you for joining us. So today we have a very valuable and practical workshop that we are going to be running through. So I hope that you're ready, you have your notepads and your pens because you are going to want to take some notes. Before I ask Balu Belz, who is going to be driving this session, I am going to just take 2 minutes to give you just a little bit of insight and context around Led by Her. So, what is Led by Her? What is it built around? And what does it include? Led by Her is an engine within the Lekker network, and it has been designed intentionally with active listening on the ground, looking at what it is that women founders, entrepreneurs, and professional women need in order to propel their professional and their personal journeys forward. So it's built on 5 pillars. It's increased access, which is access to markets, access to connections, to introductions. The second pillar is global positioning. If you want to take your businesses, your career, and also your services to other markets that you are not operating in yet, we make sure that you know everything about those markets, everything you need to know before you tap into those markets. The third pillar is capital readiness, which is very much what today's session is about. We know that we need capital for our businesses. We know that we need investor interest, etc. But are we actually ready and prepared before we go into those conversations? And do we understand what investors are actually looking for before taking up that opportunity with an investor? Then the fourth one is economic traction. What we're finding a lot within women founders and entrepreneurs, etc., is that there's still a lack of confidence to name your price on your services and what you are offering into the market. So we really want to activate that economic traction by talking about negotiations, talking about how to have conviction to actually name your price on what you are offering and not have that resistance. And the last pillar is the journeys walked by women. And that ranges from menopause, fertility, etc. But something I just want to highlight is Led by Her is a space for women and men. All the sessions that we run, it's for everybody and everybody's welcome. And the reason for that is because it's applicable to everybody. What makes Led by Her what it is the fact that it's led by the incredible woman within the Lekker network. The reason why I just waited to give the context before asking Balu to introduce herself is because Balu has been absolutely instrumental in designing what Led by Her needs to look like because of her experience within leading really successful women networks across borders. Before I tell everybody where you are based. So just on that note, Balu, please do introduce yourself, what it is you do, where you're based, and why this is going to be such a valuable session.
Yeah, I'm so excited to meet everybody and good to start sharing actually. Can I go ahead?
Just introduce yourself first before you share and go
Okay.
into the workshop.
Okay, fabulous. Yeah, I have a little bit of a more in-depth intro, of course, in the workshop that gives more context into my journey as an angel investor and why I'm just so passionate about getting more capital in the hands of founders who are changing the world. But for those who don't know me, my name is Balu. I'm born and raised South African and have been really focused on building my life and my career in the United States over the past 12 years. So that has been an incredible journey as well. I'm so passionate about building communities that focus on advancing women executives and founders specifically. The founders are my soft spot. What else can I share? Oh, I'm a very, very proud mom of two young kids. And so always happy to engage on those topics with anybody who's looking forward to connecting.
Thank you very much, Balu. So Balu's going to kick off a workshop session now, but please, we do welcome all the questions. She will be answering them only after the session, but I'll be taking note of them, so send them through as they pop up. Balu, we are ready for you. I'm going to
Oh,
pop off
okay,
my video
fabulous. Okay, great.
and you can
And
go ahead.
just thank you. And I have to give Cheryl so much credit as well. She and I have been working together over the past few months to build this incredible network, and specifically led by her. So thank you so much, Cheryl, for all of your incredible and inspiring and very clear-eyed approach to this really important work. Today, I'm so excited to share with you all about capital readiness and fundraising. As I mentioned, I do a lot of work with founders. And sure, is my screen showing right? I just want to make sure. Okay,
Perfect. Yes.
perfect. Okay, great. And so as an investor, I have conversations with hundreds and hundreds of founders, and I'm constantly evaluating pitch decks, listening to pitches, looking at decks, looking at everything that goes into capital raising. And so, super excited today to share some tips about what is going on in investors' minds when we're evaluating founders or startups worth investing in. And my goal is today just to give you a more honest picture of what investors are looking at when you're raising capital. And this is perfect for anybody who's an early stage or, thinking about raising or starting their fundraising path. If you've already started your fundraising path, I have some amazing advice as well here in order to keep in mind. So again, just wanted to dig into my background just so you understand my context. As I mentioned before, I'm an operator. I actually started my career in advertising. I think the best ads are made in South Africa, but I've really built the bulk of my career focused on building private membership communities for senior executives and founders. As I mentioned before, I'm also actively investing in consumer and wellness companies specifically. So my portfolio includes companies in that realm, and I'm super excited to share some case studies with you all today about actual companies I've invested in and the decision making that went into those investment decisions. I also advise founders, so I run my own consultancy and advisory called Motherland, where I help founders think about building from 0 to 1, building a brand, building up communities, and also really passionate about the founder and parenthood intersection. And so, if any founders are dealing with those two identities at the same time, let's absolutely chat. So this is what we're going to cover today. I really want to dive into these distinct sections, which are focused on what capital readiness actually means, the investor mindset, and the mindset of the people that you're talking to when you walk in the room. I want to talk about your story and how to frame your ask. We'll talk a little bit about finding the right investors and then some mistakes to avoid, which I hope are really helpful. I've also included 3 exercises throughout. These are individual. Feel free to make notes or take notes individually so that you can reflect on the exercises. And like I mentioned, I'll also be sharing case studies as well. So don't worry about taking notes about everything. The frameworks and what I'm sharing here today will actually stick better if you're present, but absolutely do share the questions so that Cheryl can flag those to me as well. All right, let's dive in. Okay, so let's start with what capital readiness actually means. Capital readiness is not about having the perfect business. It's about bringing your business to the point that it is investable. So the honest truth is that investors listen to hundreds of pitches all the time from founders who want to raise. But a lot of the time, what I've seen in my experience is that a lot of founders don't actually know what it means to be capital ready. And so I wanted to boil it down to really 5 questions that you need to be able to ask yourself in order to assess whether you're ready to start raising capital. So the first is you know exactly how much you need and why. So no rough estimates, no raises. It's really important to understand where you want your business to go and how much capital you need to in order to get you to that point. This links to the second point, which is explaining how the money is going to be deployed specifically as well. Your founders want to know that their check is going to be used in a way that is going to add to growth, add to value in your business, as opposed to something trivial or exploratory that's not going to result in an income, in an outcome that'll lead to them getting their capital back. It's also important to maybe sometimes connect this to a clear milestone. Um, for example, raising 500,000, I'll use dollars because that's, the context that I'm in the US, to get us to 1,000 paying customers by the end of 2026. That's a really clear milestone about how the capital is going to be used. Another one is the history of your business and making sure your numbers are clean and defensible. This is also why it's important to work with your accountant, work with your lawyers who have worked with other founders who have raised capital before and who can make sure that your business and all of the business fundamentals are actually lining up. This is not optional. Investors are going to ask about your capital table. They're going to ask about financials. They're going to ask about incorporation documents. And if you don't have these things in advance of your raise, it's going to slow down the diligence process. And when diligence slows, it slows down momentum and it gets harder and harder to close the more time passes. And then I think the fifth one is something that founders don't think about as much, but it's also about you doing diligence on us, making sure that you're researching what we do and making sure that you're approaching the right kinds of investors for your kind of business. So fundraising is a process. It's a very exhausting, challenging, trying emotionally, psychologically, sometimes physically, journey. It's not a once-off event. And what I've seen is that the founders who close rounds most efficiently actually treat it with intention, almost like a sales pipeline without being too salesy. So it's really important for you as you're approaching the fundraising stage to think about preparation. Before you talk to a single investor, before you put together the deck, like I mentioned before, you need to know your ask with precision. So not around 500K, 500, $520,000 for a specific purpose. It signals that you've run the models in your business, you've run the numbers, and you know exactly where this money is going to go. It's also important to warm up your investor targets. A lot of founders do cold outreach. Sometimes it works, most of the time it doesn't. So I love to talk about creating a warm path. Look at your network, look at other investors in in the kinds of industries that you're building, talk to other founders who are in the portfolio companies of the investors that you're targeting. Speak to angels who have invested before, like myself. I would say 3 warm introductions will always beat 100 cold emails, hands down. The fourth part of this is the actual raise. And so this is when you're going out, you're getting on a flight to New York City or to Abu Dhabi or to Cape Town, setting up investor meetings or doing them over Zoom. Either way totally works for whatever kind of business that you're doing, but you're actually having the conversations. And I think what's most key to call out here is that you're having conversations in parallel, not speaking to one founder, waiting for them to commit and wire the check, and then speaking to another founder. You really need to be casting as wide a net as you can. One of the things that I will tip you on as an investor is that sometimes we wait to see who else is investing. And so you kind of want to bring a crowd with you. And then, being really diligent about that clear timeline that you're communicating, following up diligently with your investment, with your investor prospects, tracking your momentum, and then really once you have that interest, moving fast. Diligence, like I said, can slow things down. So you really need to take the next steps quickly to get that capital once you've gotten the commitment from your investors into that bank account. So that's really a great way to think about how you want to plan your fundraising process. Let's talk about the investor mindset and what we're thinking at all times. Before I dive into that, I want to talk about the different types of investors. I've already shared that I'm an angel investor. So angel investors are typically writing checks of $5,000 to $100,000, depending on personal capacity. We are really early stage, and that's the top right block, by the way. Really early stage, the most high risk bets imaginable because not much has been proven in the business yet. But usually former founders or operators, and we typically move faster than venture capitalists. I'll also talk a little bit about friends and families because those are valid investors as well. These are usually people that know you very well. They'll usually invest at the very, very, very beginning of the business to help breathe life into your business. So you get those types of investors as well, and might be worth it to look in your own network and see if you have those. We also have venture capital or venture capitalists. So these are usually investors who have a fund. And basically, what they do is they use other people's money to invest on their behalf. So it's they need big outcomes in order to return all of that capital to all of their limited partners, is what they're called in a fund. And so these general partners are really tasked with the responsibility to manage people and people's money well and invested wisely. So there's way more process, more diligence, more board involvement. I would say typically what I've seen in venture capital is that it can take several months to assess a deal. With an angel investor, I can make a decision about whether I'm investing in a company within 2 days to a week. So it's much, much quicker. And then private equity, just for context, comes much, much later after the company has been around for a while, has proven quite a lot. Private equity companies or investors usually start coming in when they're thinking about whether a business can go public or exit through some kind of merger or acquisition or that kind of thing. So not really relevant as much to early stage, but just wanted to put it there for context. And then let's quickly talk through the stages of fundraising as well. So I mentioned friends and family who typically come much, much earlier, usually first capital in. It depends. Not everybody has friends and families who have the capacity to invest, but if you do, great, go for it. And then we have what's called the pre-seed round. So this is usually where you as a company are raising anywhere between 150K to one-ish million dollars. This is really where you're starting to validate the idea. The investors are betting on you and your insight. Sometimes there's some traction, sometimes there isn't. Pre-seed and seed can really overlap in terms of traction, but seed is really where you have to start showing any signs of traction. This can look like serious letters of intent. It can look like paying customers. It can look like real revenue that you're generating in the business that's showing some sign of growth or ability to scale. And then Series A and Series B are also kind of early stage investing. I usually focus on pre-seed and seed. I've done a little bit of Series A because Series A is really focused on like really running, really scaling, based on you knowing what's working and just needing the capital to scale in whatever way you need to grow your business. So investors are constantly asking a lot of questions, as you can probably imagine, but I would say the main three fundamental questions that you need to keep in mind, because empathy for your investor is such a superpower, I would say, is will this return my capital? So, like, is the market big enough? Is the business model credible? Can this business exit? Can this business grow to $100 million plus so I can actually get back a meaningful investment? The second is this founder the right person to build it, right? So do you, as the founder, have some unique insight? Have you demonstrated that you can execute? You don't have to be the best founder in the world. You don't have to be the only founder in the world building in this space. You just have to be the right founder for this business. So I want to talk about thinking about your unfair advantage and starting to frame your story and pitch yourself in a way that makes it undeniable that you can win. But we'll talk about that later. The third thing is why now? Why can't I wait 6 months? Why can't I wait for a year? Why do I have to write this check right now? And so this is often the weakest answer in a pitch, to be quite frank. Usually we hear things like the market is growing or this is a $20 billion market opportunity. That's fine. But that also tells me that seven other founders can build a company just like you and chase the opportunity. Again, why now? Why you? And what is the likelihood of you being successful? So I wanted to dig into actual case studies of companies that I've invested in and kind of share the decisions that kind of go through my head or the decisions that I made in order to choose to invest. So the first is a company called Moxie. It's a flexible childcare tech company in Birmingham, Alabama. So, four things really stuck out for me when listening to the founder and meeting the founder and really engaging with even other investors and deciding how to invest in this company. The first is there's a critical childcare crisis in America. It's very real. It's growing. Millions of families feel this pain every single day. As a parent, I know it as well. And so that answered one question to me immediately, which is the market is enormous and the need is urgent. I, as a customer, can put myself in a position where I understand why this company exists. The second, which is interesting, and I love to call this one out about this deal, is that it was a completely overlooked market. Everybody is building shiny, attractive things for New York City and LA and San Francisco. Nobody's thinking about Alabama, but it's still underserved. People are having babies and families in Alabama too. People need childcare in Alabama. So geography is not necessarily a weakness. It can actually be a moat. It can be what sets yourself strategically apart from other competitors, other companies who are building childcare tech across your geography as well. The third thing that was interesting is they do have two physical spaces that run as childcare centers or creches or daycares or whatever you want to call it. But they actually have embedded a technology play or a technology layer as well, which is they've built their own app to help manage registrations and basically their customer pipeline and their customer um, um, journey, but they also license this technology to other childcare centers. So they've turned two locations, which are very fascinatingly fantastic test locations, into an entire platform that is replicable and scalable. So that's what tech usually has an interesting way of making something really compelling in terms of scaling. And then two, the founder story. I always say yes to the founder as well as the company. She's a former childcare worker who built the solution that she needed. She has the deepest possible understanding of exactly what she's building. She's solving for problems that she's experienced as a worker in this problem, and she's also just one of the most impressive founders I've ever met. So I think overall, for me, it's like the best opportunities are sometimes when no one else is looking. Geography doesn't have to count you out. It can actually put you ahead of many others, including competitors. And always think about what's different. Always think about the deep problems that need to be solved most urgently, and what's going to make your customers say yes to what you're selling. Okay, so now that we've talked a little bit about mindset, I want to get us to a point where you can control what's in your court. So if it's okay, would love to think about doing an exercise together, which is really founding your founder statement. So I would encourage everybody here to take 1 minute to complete your founder statement in 1 to 2 sentences, depending on how you feel. But what's most important to crack here is understanding or being able to communicate what you're building, for who and why. And it really has to be your unique reason. And then the second thing that your potential investors are going to want to know is why you are the right person to build this. So, what is your unfair advantage? Feel free to screenshot this too if you want to do it later. Absolutely no problem.
And while everybody's just taking a moment there, Balu, there was a
Mm,
question on whether we would share the slides. Unfortunately, we won't be sharing these slides.
mhm. Okay. I'm going to move on because I think what's also important here is to be able to come up with reasons fast and not to overthink or over edit yourself. So again, um, think about what you're building for who and why you're the right person to build it. And I think this ties next well into the next slide, which is really thinking about the framework for your actual pitch. So really what's most important to make sure that you're conveying to your potential investors is the problem and making them feel the urgency behind the problem. This is why this needs to happen now. And if we don't build this right now, the world will not change, right? Like it's really that important. It has to be that compelling. Why now? So, what's changed recently in the industry, in our world, in our lifetime, in business, in technology that makes this the right moment to build this company right now and to invest in its growth? The third thing is the solution. Simple, clear, visual if possible. If it's a brand, show the brand. If it's a consumer package, show the packaging. Like really put as much of the product or the solution in the investor's reach as possible so it feels like a tangible business that is living and breathing. Why you? We've already talked about this, which is why your founder statement is so important. You also refers to your team as well, your advisors as well. Anybody who's helping you build this build this business up is important, and investors are always evaluating who's actually driving this forward. Any early traction signals, so what you've already proven, what you've already accomplished is great. Business model, so how do you make money? How does it flow? How do you scale? What's the end goal? Do you want to exit? Do you want to go public? Having as crystal an idea of that as possible is usually helpful. And then the ask, getting very specific on the amount, the use of funds, like I mentioned, milestones. And in the next slide, we'll talk about communicating your ask and the vision. I would say the two sections that I see that usually need to improve in investor pitches are why now and the ask and just getting clearer on that. But let's talk about the ask and then I want to talk about as well. Yeah, I'll actually cover both. So let's talk about the ask. So this is where a lot of founders actually lose the room, not because the business is weak or that it's not investable, but because the language just signals uncertainty. And I always like to say that uncertainty is it's like it's contagious. So if you are uncertain, everybody else will feel uncertain. And so investors, like we also want to fund confidence, not arrogance, but like confidence. So I've put on the left side of the screen some example of weak asks, like we're looking to raise somewhere around 500K or so, or we're open to different structures, or we're talking to a few people, but nothing firm yet. Investors are very busy. They like this is not helpful. So I put on the right side of the screen some strong asks. And again, this is a very US specific ask, and this is very much like investor startup language. So, this will apply to your specific type of business, whatever you're raising. But like, if you're talking to me, for example, I would want to know, I would want to hear you say that you're raising $500,000 pre-seed round. That tells me that it's early stage. I shouldn't judge too harshly about traction on a post-money safe, right, which is a type of investment vehicle with a $7 million cap. That tells me everything that I need to know about how you're evaluating the state of your business today and how you're what the valuation of your company is and what you're thinking for in terms of the future. Another way to be clearer in your ask is saying specifically, we're targeting to close in 8 weeks. That way, the investor or potential investors knows what's the timeline. And then also what's helpful to know is what's driving that timeline. Usually investors will say, oh no, we have a signed agreement with Whole Foods to get into 600 of their retail stores. It's like, oh my gosh, that's fantastic. Let's go, right? So as much of that context is really helpful. Or even thinking about who else you're talking to as an investor. If you're raising $500,000, it's really helpful for me to know you already have $150,000 committed, that you have a lead investor, and that you're just looking for other co-investors. Like as much, again, this is just about confidence and communicating clearly as opposed to leaving your investors in the dark. So let's talk about another case study that this is another company that I've invested in called Press Roots. This one is just such a special one. They basically describe themselves as the Dry Bar, which is a chain of hair. It's like a hair blowout bar here in the United States. And so what was compelling about this for me is that this is an underserved market. Again, I'm the customer. Black women are constantly compromising on care and quality when it comes to our hair. There isn't really an amazing scaled premium salon experience for Black women or women who have ethnically textured hair. And so, again, get the market immediately. It doesn't exist. Okay, you're building it. The second thing was proven traction. They had 4 stores already open. This founder had raised previous rounds, but when I came in, they had 4 stores operating in Texas. You can go look at the website, you can book an appointment. They're real customers, there's real revenue, there's real proof of demand, even before this pitch. The third is that IP is always such a special thing. If there's ever anything that you're doing in your business that's proprietary, it's amazing. So they're building the certified 12 steps roots method. They have the academy called the Silk Blowout Academy where they take through, hair care. They train people on this. So this is a repeatable, teachable system that can be very hard for competitors to replicate or build from scratch. And then the fourth thing for me that was exciting was the positioning. I've known about Dry Bar for years. They did incredibly. They were acquired for over 200 million in 2019. So you signaling to me that you want to be Dry Bar for textured hair tells me exactly about your ambition and where you're trying to grow. Sign me in. Sign me up. So love this one because the customer knew the founder knew her customer completely. She was the customer. So again, that founder market, fit is just so critical. And then that lived experience being an unfair advantage, having the traction, having the certified method, that's something that just puts you far and away from any possible competitor coming into this market opportunity of a billion plus, but trying to build the same thing you have. It's much, much harder. So this is one of my favorite slides. Whenever I see a pitch about with these words, why we win, I know exactly that this founder knows what they're doing. And so I would love to invite you all to do the second exercise. Not right now. Feel free to screenshot it if you need or write the questions down. Is being able to articulate why you will win. Because again, this is a massive market. There are other people building similar companies to you, but the investor wants to know why they're backing the right company or the best possible company to get them to the finish line, which is returning our capital at an amazing multiple. Um, so thinking about why you are specifically the person to build this company, and then what you've already done to prove that. And it's really as simple as that. So think about why you are the right person to build this and what you've already done to prove it. And then you should be able to articulate your unfair advantage in 15 words or less. How are we looking on time, Cheryl?
We doing good. We have about 13 more minutes to reach your
Perfect.
45, and then we'll still take questions.
Amazing. Amazing.
These look
Let's
like
take
such simple questions, but the intricacy is really important, right? Because, like you said,
yeah,
the market is massive. There's many players in the market, and you really need to crystallize why you.
exactly. Yeah, exactly. Okay. So thesis alignment is something that is talked about much less, I would say. It's one of these unspoken things that make you go once you're fundraising or even later down the line, it's like, oh my gosh, I wish somebody had told me that this matters. I would have saved so much time and energy in an already demanding and draining process. And so I love to talk about thesis alignment and also creating the warmest path in. At the beginning of this introduction, I shared my thesis, and I try to share it early and often so that any founder who's looking to have a conversation with me about potentially investing is just very crystal clear on the kinds of companies I'm paying attention to, and so that it also becomes clear what companies I'm not paying attention to. Again, we only have 24 hours in a day and we all have a lot to accomplish. So I mentioned earlier that my thesis is I invest in founders who are solving for the health and happiness of women, mothers, and children. And so think about that as we're talking through some signals that investors are looking for. I kind of glossed over all of this prior, but I really want to get into the specifics of it. So, four things: traction, insight, ability to execute, and directional velocity. So let's get really specific. When we're talking about traction, you can have traction even if you're pre-revenue. It's just about articulating the right kind of traction. A 500 person wait list, for example, that's an example of traction. That is an example of people knowing that this is a problem or a business that needs to exist because it's a problem in the world and you are building something that needs to be solved. 20 discovery calls with potential customers. That is also an example of traction. Letters of intent from enterprise buyers. Traction is a proof point of market pull, not just you being the founder pushing. Insight is also really important to dig into more. And this is one of the most things that I would say founders undersell. So, insight would be like, what do you know that others don't? I mentioned this before, but what is your proprietary edge? Is there network? Is there data? Is there lived experience, like we talked about with Press Roots and Moxie? Is there domain expertise? For some of you, it might be lived experience. For others, it might be a decade or more in a particular industry. Don't hide your unfair advantage. Lead with it. Because again, that's what's going to show or help you build your moat. Moat, M-O-A-T, is a word that you'll hear often in the startup or investing space. And it refers to basically it comes from the imagery of having a castle way up and then having like the moat around the castle with like I think if you think about like the old medieval castles with the moat and then sometimes like comically there's like crocodiles in the moat or whatever. Just it's about keeping away competitors so they don't overtake your castle, right? Like that's kind of the imagery. So when you're developing your moat, when you're fortifying or defending your moat, it's really like your unfair advantage can really be helpful in this. Your team, your expertise, your experience, anything that's proprietary, that strengthens the moat. That's what makes your moat defensible. So I want you to know that if you ever hear, potential investors asking that question. It's also about ability to execute. So who's been in the room, who's built before, especially so hiring talent for your team, for your startup is so critical. We look at that. Can you hire? Can you sell? Can you navigate hard pivots? And then the fourth is really directional velocity. So how are things moving? Are customers like for example that 500 person wait list, are you able to convert them to customers? What is press coverage? This one's good. What are partnerships? What are product milestones? Like what's your V1, your MVP, then your V1 and your V2? How quickly are you moving through improving your product? Show motion, show progress. This helps your investors know that they can believe in your ability to execute. So Finding the right investors is also really important. I know, I wanted to throw in just some examples of globally just incredible investors that I've come across as well in my career. I think the best way to think about finding potential investors is research thesis alignment before every outreach. And we'll talk more about thesis matching in a couple of slides. Also, mapping your network for second degree connections. This is not the time to be hesitant. This is not the time to be, lack confidence. It's a real shame to not be able to raise capital just because of like insecurity or imposter syndrome. And that's why I work with a lot of founders to kind of overcome those things so that you can set yourself up for success. Building relationships before you're raising as well. The best investors already know you when you call. A lot of companies I've invested in, I've known about for a year or two, kind of, just network effect stuff. Great platforms to look at: Angel List, Crunchbase, your LinkedIn, PitchBook, investor newsletters. If you're interested in a specific angel, connect with them. If you're interested in a specific VC firm, subscribe to their newsletter, attend their events. There's always educational opportunities to plug yourself into these ecosystems that already exist. In South Africa specifically, there's also a lot of governmental initiatives that are incredible because they're focused on small business owners, and the capital that you're raising is non-dilutive. That means you don't have to give up equity. They hand you a check and help you grow. That's really, really important too in the early stages where your capital is gold. Right? When you're turning to angel investors and VCs, you're giving up capital. So it's really important to think about non-dilutive opportunities where they exist. And then also just wanted to give some examples of investor resources for women founders specifically. This is a space that I play in, of course, so just wanted to share that as well. South African Angels Investors Network, Swizzle Ventures, Mother Ventures, First Check Africa is an amazing one. Artemis Fund is an amazing one. She Equity as well, which is based in Africa as well. So just some great ways to think about it. And then to, again, I mentioned this before, but empathy for your investor just being a fundraising superpower. So really understanding once this person has written the check, what they're thinking about in terms of the upside. In the deals that I'm sharing and in general, I'm not going to share specific numbers. A lot of these companies, well, all of these companies are actually private, so I can't share like inside information about the companies. And also, every company is raising, deal terms vary, but directionally, a good outcome for investors is dependent on fund size, stage, portfolio strategy. But thinking about making sure that when you're pitching, you're understanding that the questions they're asking themselves is, what am I going to get out of this? How does your company fit with their thesis? And then can you also speak to comparables? So like what other companies in the industry or the space that you're playing in or building in have exited and at what multiples? How have they grown, right? In terms of valuation and revenue. And then, yeah, just putting your best foot forward. Investors love founders who've done their homework. So our last exercise of the day is called thesis match. So this is really where you think about the kinds of investors that you're targeting and thinking about how you can match to their thesis. So every single investor that you're potentially going into a meeting with, you need to be able to answer these questions. What is their investment thesis? Stage, sector, check size. What do they care about? How does your company fit or not fit their thesis? And then what is one question you will ask them about their thesis in the meeting? The third question is a fantastic question to ask in the meeting because you can't assume that they know who you are and what your research you've done. But if you're a founder and you're pitching and you're telling me, my thesis, oh my gosh, it's just such a great sign. So that's another small tip. Okay. Third case study is Surrett. This was actually my first ever angel investment. So I'm really proud of this one. Surrett is a certification seal for motherhood safe products. So it's Squarely CPG. And what they do is they've created a it's similar to like a clean label project or EWG, where when you're shopping, you're looking for products that like have that seal that tells you like, okay, these has been tested, these are safe. And I have a soft spot for this too because I'm a mom and I try to be cautious about like how I'm buying and what's in my home. And if my baby accidentally drinks a bottle of things, like I don't have to rush them to hospital. Clean, non-toxic products. So what I loved about this one is first mover advantage. Um, Sometimes this is great. Often it is not because of copycats and competitors who follow. But when you can get first mover advantage right, it's amazing. So, of course, in the world, there are many kinds of certification seals, but there hasn't been one for motherhood. There hasn't been one specifically for consumers that's focused on pregnancy and postpartum breastfeeding and making sure that mothers have peace of mind when they're shopping for makeup, creams, hair products, etc. So in this regard, first mover advantage is just so hard to replicate. You can't be realistically another motherhood um, focused seal. So this was great. This was a fantastic moat. It's also one that's built on trust and I think scientific credibility. Another thing that impressed me about this founder is she built the most incredible and impressive scientific advisory board. These are experts in, dermatology and medicine from all the best institutions, Harvard, Stanford, who worked with her on a process of understanding which ingredients are safe, and making sure that the seal is actually credible and defensible. They go through thorough testing and have a real methodology that's also proprietary, by the way. The third was founder market fit. So this founder had deep CPG experience, has worked for companies that create and bring products to market. So understands that entire process. She's not starting from scratch. She also understands both the brand building side of things and also has respect for the science side at the same time. And then also the TAM, which is total addressable market, as in what is the opportunity, what is the largest opportunity possible to make money out of this market? And then timing as well. People, simplistically, again, I can't share specifics from her deck, but simplistically, people will have babies forever. Okay. Moms will always be shopping for consumer products. And so the TAM is infinity, right? And so the market opportunity is infinity as well. And so, as well, I think the timing on this is important because the maternal wellness market itself is just enormous and continuing to grow globally, and consumers are paying attention, more and more attention to what they're buying. It's definitely shifted from when I was growing up until now. So for me, this was great from a science and community standpoint, understanding how to respect science, build a community, build a brand, and then build a really defensible product that people can buy into. And so hope that kind of is helpful as well. Okay. Finally, let's talk about mistakes to avoid. This is I wanted to this the next slide is one slide. I had to trim it down from two because there's so many things. But I hope that this helps you think about um the quickest things to address, I would say, the things that'll save your time. And I always talk about shortening the distance between A and B. I love efficiency, I love clarity, I love getting to the heart of things. So as it relates to this, think about how you can shorten the distance between your pitch deck and your check. And so these are common pitfalls to avoid. The first is raising too early. That's why at the very beginning, I talked about different fundraising stages. Not every company should be raising a Series A. Sometimes it makes sense to be raising friends and family rounds or pre-seed rounds or even a seed round. So when you're raising too early or not raising at the right stage, it can come up as risk to investors or just create confusion around whether or not you are assessing the opportunity well. And so really think about the minimum traction or fundamental things that signal that you're raising at the right time. The second one is treating all investors the same. And this I'm sharing more out of empathy and understanding for founders who work very, very hard as well. A $5,000 angel who's writing checks is not the same as a $2 million VC. They're usually evaluating different things. They have different resources. I'm not a VC fund. I vet deals myself. And so you really need to think about where you're spending your time and energy intentionally, and then tailoring the narrative and tailoring how you're pitching to these different audiences. The third is pitching the market, not yourself. So again, the opportunity, the 2 billion, 10 billion, $50 billion opportunity, that's just what gets you in the room. What's going to get the investor to write the check is you, right? So don't undersell the why you case. Um, Sometimes we get pitches from two companies building the same thing at the same time, right? So again, it's important to understand how you are different and why you will win. The fourth is apologizing for being pre-revenue. I mentioned this already, but it's fine to own your stage. In fact, that confidence is what helps your investor be more confident in what you're doing as well. Pre-revenue with strong signals like wait lists or LOIs, that's perfectly fine. I've invested in a consumer business that had no product on the shelf, like did not exist. It's fine. The fundamentals made sense as well. So you don't have to crouch or, perform smallness or pretend to be something you're not. It's completely fine. Letting diligence drag is also a big one. So letting that momentum stall, investors get distracted. I knew I had to say no to investing in a deal when it had been 3 months and I really wanted to love this company. I really did. But it had been 3 months and I just did not know what to do. And I said no because I realized that in all of that diligence, in all of that time, my questions still hadn't really been answered. And I still didn't feel confident in the deal. So move quickly, set a close date, stick to it. And then the sixth is treating not right now as a permanent no. So sometimes, an investor will decide that they're not ready to invest in your company, but that doesn't mean they want to shut the door. It's okay to ask if they'd like to stay in touch and reconnect down the line. So most first checks come after multiple touch points. So a no today can often mean revisiting down the line. So yeah, it's always great to share progress as well. I know we're almost out of time, so I quickly want to talk about what we didn't cover. And these are probably questions in your head, but there's so many different kinds of funding vehicles. Happy to talk with anybody about like building your cap table, diligence prep, pitch coaching, writing investor updates, which is really, really important, and then negotiating term sheets as well. Every company is different, so it's really important to get specific, and then investor and board management as well. This one's really fun. And so, what I would leave you with is just really being able to think about your raise amount and the milestone that it's going to get you to, and then identifying three investors whose thesis aligns with what you're building, and then mapping the warmest path in. Figure out the warmest path to getting to those investors, practicing your why me answer out loud, and then sending one investor update or one relationship building note this week. Thank you so much, everyone, for listening. I hope this was informative, and happy to connect with anyone on LinkedIn too, if you'd like to chat further. I'm going to stop sharing because I hope we have some questions, but um, thank you. Thank you, everyone.
You do have some questions. Can I just say, wow, that
Okay.
was brilliant. Your
Okay,
storyline, the
fabulous.
way that you flowed from the mindset all the way through, and the point that you mentioned, these are probably the questions that you have in your mind. We need more sessions that dive into the pitch and all of that good stuff because you're right, those questions are pending. But let me start with one of the questions over here. The question is, and you did answer it in some aspects of your delivery. When it comes to pre-seed investment, how is the business valued if there are no customers yet? Does pre-seed always include equity, or is it purely an agreed return on capital transaction?
Yeah, yeah. So whenever you're raising capital from outside investors, it's equity, like it's equity raising. So your investors are getting for their capital a dedicated amount of equity. I would say, yeah, pre-seed and seed, like I mentioned before, they are other traction signals. I mean, it's also dependent on the kind of company. So I'm happy to get specifics if, you want to ping me on LinkedIn or anything about the kind of company that you're building and what kind of attraction signals. But like I mentioned, like contracts, signed agreements, or even letters of intent, customers, wait lists. Sometimes, in the spaces that I build, you'll have founders who have paid wait lists. Like somebody puts down a deposit for something, even companies like Tesla and that kind of thing, you pay deposits, right, for something that you'll get later that's still being innovated. So yeah, happy to chat more, but that's a fantastic question.
Thank you. The next one is, how much time does a founder typically have to pitch to investors or a
Mm.
committee?
Yeah, I mean, yeah, this also depends on the kind of business that you're building. But I've seen fundraisers that last several months. I think the longest one that I've seen lasted like 9 months from start to
Oh,
finish. Yeah, it's a marathon, and but this founder really struggled, right? They were like kind of this is the thing about sequential and not in parallel is like have as many conversations at the same time. Don't over index on somebody who's committed who then falls through and then you have to pick it back up and like have additional conversations as well. And so like I mentioned, yeah, I think several months makes sense. I think anything between 3 to 9 months would be totally normal from start to end. But from an investor standpoint, I make decisions much, much quicker, as I mentioned.
great. Then we have another question from King Polly. At pre-seed and seed stage, what forms of traction do you take most seriously?
Uh, Again, it would depend on the type of business. Um, do we have context on the type of business or no?
No, Kim, if you'd like to just give more context, you may. But I think
Mhm.
it's a combination of the things that you mentioned, right? The market, the problem that's being solved, the urgency of it, etc. Okay, then Heidi's asking, what is a reasonable time period to expect an investor to accept or decline the opportunity to invest?
Yeah, I would say for a venture company, like anything in under, like a VC firm, um, under several weeks, so like a month, and then for an angel investor, even less time than that.
Okay, great. Kim is going to provide us with more context, but we have one here from K Young. If one goes the venture capital route because you don't want to share equity, what are typical interest rates and repayment timelines to expect?
Yeah, so if you are looking for venture capital investors, you are in equity investing. So venture capital investors are only investing for equity. So I think we might need to connect directly just so I can understand the crux of the goal that you're chasing.
Fantastic. Moving on. So this is the context that Kim Pot is providing from that seed pre-seed question. So they are building a risk intelligence and reputation advisory platform for organizations that are operating in complex and contested environments because traditional consulting and monitoring approaches are too slow, fragmented, and reactive for today's risk landscape. They help leaders understand how stakeholder interpretation becomes business consequence
Hmm.
and the risks that get them there. We are the right team to build it because we combine decades of experience in reputation, stakeholder risk, geopolitical analysis, and strategic communications with proprietary frameworks that they have already been tested in real-world environments. So the
Okay.
question again at pre-seed and seed stage, what forms of traction do you take most seriously?
Yeah, with that kind of, it's breaking up a little, but I think what I gathered is Okay, so when we're thinking about traction, the best possible way or the best starting point to think about traction is customers. Like, have we acquired customers? How are those customers engaging with us? What are usage metrics? Are they paid customers? Are they different tiers of paying customers? So I would say for a business like that, that sounds like software. I think if I heard it correctly, it's users slash customers or even like enterprise agreements. Even if you have pending conversations or, inbound interest from specific companies, those are fantastic signals of traction.
Okay. It's consulting services and it's multinationals.
For
Perfect, Balu. I know
consulting
that we are out of
services,
time.
very similar, very similar, very similar. Hmm.
But I just also want to tell you there's so many beautiful feedbacks
Oh,
here.
cool.
Bala is amazing. This was an incredible session.
Okay.
Quite a few that mentioned they are going to connect with you on LinkedIn to just take the
Okay.
conversation further. And yes, that's what it is all about, taking the conversation further and getting a bit deeper. And Balu, we'll definitely have another series on this, going a little bit further into the practicality sides of it. But thank you so much for your time.
Of course.
For everybody that's tuning in, please do stay tuned on the Lecker Network LinkedIn profile just to see the next upcoming sessions that we are having. Like I mentioned, there are 5 different pillars that we are speaking to and activating. Next week's one on the 10th of June is about menopause, but there's different angles that we are going to be speaking to, and we also have a male voice joining the conversation that will be speaking to how do we support or how do males support their spouses, their partners, etc., on the journey of menopause and many more conversations like that. So thank you all for joining us and have a lovely day further. Thank you
Thank
all.
you.
Bye.
Thank you so much. Bye.
Thank you, Balu.